you just cannot justify the valuation of most projects in the space. And it's a classic Silicon Valley meme of like never show revenue, always sell the dream. Crypto's no longer the main character, right? It's AI. So from a momentum driven trade, over. From a valuation fundamental trade, over too. Like Ethereum as a $400 billion asset, Avi, Jonah, in what right mind would you buy this when it's cranking out 1 to 2 billion of fees that are not recurring, that are going to dry up in a bear market when liquidity is there? Like you're churning through most users and liquidity every month when people get liquidated. I just cannot make a case to buy Ethereum. I'm not getting paid enough. I'd rather punt AI.
This episode is brought to you by Zcash. You'll hear more about them later in today's episode. Nothing said on Empire is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed.
Today's a crazy day. The last time we recorded, Bitcoin was above 100,000. Today we're recording, Bitcoin's at 94, and things are dropping precipitously. It looks like the timeline's very anxious. So in order to assuage those fears, we brought on our professional market man, Santi. Thank you for joining us today.
Avi, Jonah, thanks for having me on.
Thank you. No, this is awesome. I think Jonah and I have talked about this a little bit high level on a bunch of podcasts where we basically just keep saying, hey, the market is changing dramatically. And I think it already has changed dramatically a bit. And then you put out a blog post this morning, which I'd highly encourage everybody to read, which really tackles like the issue of valuations in crypto, and why we might be experiencing some of what we're experiencing right now, where things just keep kind of coming apart. Other than Bitcoin, I mean, if you look at this cycle outside of Bitcoin, very few things have actually performed well. Most things are down, even though we've been in a quote unquote bull market. And, the things that are down are kind of the things that we've always made fun of a little bit, but there are also things like Solana, right? Like Solana's sort of sideways for 4 years now. Ethereum is sideways for 4 years now. And, when you look at it on the grand scheme of things. So I guess that's something that was top of our mind, that, basically like what's happening? Like why are things not going up?
Look, I mean, when you look at it at a fundamental analysis, like you just cannot justify the valuation of most projects in the space. And it's a classic Silicon Valley meme of like never show revenue, always sell the dream. And perhaps that's like the greatest credit I'll give to Ripple, which is they've done a phenomenal job. If you go out walking the street, you ask people, hey, what do you think about crypto as a infrastructure, this fintech opportunity? They're like, oh, it's Ripple. And it's not Maker, it's not Uniswap, it's not, anything really. But like zooming out a little, it's like, do you always as an investor, it's like, is it priced in? And it's a hard question, but I think the market already told you that it very much was priced in. You had every narrative that you could have imagined, every headline imaginable, to the point of JP Morgan launching their own deposit token on public infrastructure called Base. Prices are not moving, they're going down. Now, Bitcoin is in a camp of its own. I think that's like the reasons why you want to hold it. I think the macro thesis, the hedge, digital gold narrative is intact. Like it's less than 10% of gold's market cap. You want to kind of have it in your portfolio. For everything else, it should be valued as a technology play. Crypto is no longer the main character, right? It's AI. So from a momentum driven trade, over. From a valuation fundamental trade, over too. Like Ethereum as a $400 billion asset, Avi, Jonah, in what right mind would you buy this when it's cranking out 1 to 2 billion of fees that are not recurring, that are going to dry up in a bear market when liquidity is there? Like you're churning through most users and liquidity every month when people get liquidated. I just cannot make a case to buy Ethereum. I'm not getting paid enough. I'd rather punt AI.
Yeah, I mean that's been a huge issue, I think, for just crypto traders in general, is that outside of this crazy run by Zcash recently, and I guess the meme mania of six to 8 months ago, trading the stock market has just been infinitely more fun and profitable than trading crypto. And I think we all know that a tremendous amount of value is derived from the fact that crypto was a very fun place to trade. And like it was a place that you could make a ton of money. And now that's starting to dissipate. And what actually kind of worries me more is also crypto is like the one place that you could get a ton of leverage to go. Let's say you had a small account, you had you got $1,000. You could lever that up 10, 20, 30. You could go 100x long on BitMEX. And you could only do this with crypto. And now, I mean, Hyperliquid's introducing stocks. I would wager like in the next 2 to 3 years, you're going to be able to trade stocks on pretty significant leverage as well on these platforms. And then that's like another just punch in the throat for all like the stuff in crypto that isn't real. And mind you, like there's some stuff in the stock market that's that's real. Like there are people minting money on buying rare earth minerals because we're in a rare earth mineral war with China. There are people that had minted money on buying small cap drone stocks now that drones are much more important in warfare. It's like you can actually put your mind to work in the stock market, whereas in crypto it seems like I mean obviously there's real stuff being built. It's just less so.
Yeah,
right
maybe
now,
penny stocks are the new crypto. Sadly, we keep
always have been.
I mean,
yeah.
crypto's always been good at, because in the early days, it just has created this public infrastructure, like 24/7, 365 markets for everything. So like no one's really kind of disputing that. I think there's a real industry behind that, and the same with Vegas is a very real industry in Macau. My question and where I come at it is, should it be worth 1.5 trillion today? Like excluding Bitcoin, should that opportunity be worth 1.5 trillion? And if it is, can we actually support the valuation? Because when you look at it on a revenue generation value capture standpoint, it's only going to get harder for most of these chains to capture value. And so I get very nervous when I think about that. And I think a lot of people in crypto come at it like something you said earlier, just banks are going to use this, and you're seeing all these headlines. The problem with that is, was it priced in? Because the market's not stupid. It will play short-term games. It will, be momentum driven, but it's not stupid. And I think it's one of those things where, yeah, AI could be in a hype phase, but at least you can look at something like Nvidia, and it's trading at 30, 40 times earnings, and Ethereum's trading at 200 times sales. Like, make it make sense.
Yeah, it doesn't make sense. I mean, I think one thing that my old boss, Don Wilson of DRW, told me is, when I was asking this same question, which you could have asked during any of the previous cycles with these ridiculous valuations on certain altcoins, like, why is this, how is this token so stable at such a multi-billion-dollar valuation when it's obviously vaporware? Like the team has literally packed up shop. They're not shipping new code. They're buying villas in Sardinia. They're not doing anything. Why is it still worth what it's worth? And the answer I got from Don, which I think is kind of prescient, was, hey, Jonah, tokens don't file for bankruptcy. Like these valuations can just be sustained for a while. And I took that as gospel because at the time it was true. But I think what needs to be realized now is that we're entering a new paradigm. Like you talk to any crypto investor about shorting tokens, they're like, ooh, that's tricky. Can't do that because it's been so hard, right? Maybe now is finally the time where you can just sell stuff because if sentiment on CT is any indication of how people in our space feel, what was supporting those valuations was not revenues, to use your word. It was the dream, as you said, right? It was the dream of future revenues that was supporting them. So now participants, insiders, crypto natives, bag holders are throwing in the towel, and that, even though the project itself might not file for bankruptcy, that can certainly take altcoin valuations down a lot. So maybe that's the trade. Maybe we're just supposed to suck it up and short stuff.
Look, I was sitting there in 2017 and 2020. You could have heard me say, hey, the top 10 is going to change. Like, how is Cardano still a top 10 coin? There is a part of market psychology where it's a meme. And so there is credible flows attached to that, and there's social value. And I'm not here to discount that. It's just, as an investor, I get worried when I have concerns around the broader market valuations, not just in crypto. And so, will I be willing to hold this thing? Because you just know liquidity dries up and markets really, and these things really tank 80%. And so more from coming at that standpoint, like building a long-term position in things. One is a speculative gamble as you go to Vegas on a weekend. The other one is, are you an investor? And I think like there's always been a part of crypto that is very much speculative driven. And look, I'm not here to fight or short irrational degen behavior. However, I think something like Ethereum and Solana and some of the other networks, look, it's just a ask folks, the Ethereum maxes, the Solana maxes. I'm not here to just take a stab at Ethereum, like Solana as well. Pretty much every L1, L2, like look at it. But like double clicking on Ethereum for a second is you constantly have this like investors, even the most successful funds out there. Well, you read their LP letters, and they're all saying kind of the same regurgitated thing, which is it's a world supercomputer. All this flow is going to get tokenized, and it's going to move on chain. And like I don't think anyone is discounting that. Larry Fink is not discounting that. Jamie Dimon is no longer fighting that. The regulator is not discounting that. The question is, you have all those headlines and prices are going down. So it was very much priced in. And so there was zero margin of safety. The question is, as soon as you start showing that traction, the market was like, oh, okay, yeah, but still, from an MEV standpoint, most of these networks are not capturing 100 times more fees. And you need to kind of see a path towards growing the user base 1000x and the users and the fees attached to that 1000x, which is not here yet. So why would I go out of my way to buy something that is priced to perfection? Because it takes a mouse fart from Powell and Nvidia's earnings to be down that quarter to blow up that thesis and be down 80, 50, 60, 70% of the position. I just have no interest in doing that anymore. I've been around this game far too long that I don't want to round trip all this stuff.
You could 1000x users very quickly without 1000xing prices. I mean, I think shout out to Inversion Capital. You guys are kind of proving that, right? Like launching new blockchain tech is commoditized. So Ethereum and Solana aren't like digital New York City anymore with limited real estate where you have to own ETH or SOL to capture economic activity on chain. Like you're building new economic activity on chain on your own chain. And I guess what does that mean for the rest of the space? It's kind of like, all right, maybe this is when the valuations compress and then we'll get another dip to buy, because I'm not giving up on you. I think users will come in way faster if the valuations are normal. You can see that from token launches. Like when a token launches at a fair price, the community thrives a lot more over the long run than when people buy the absolute pico top and get dumped on. So maybe that's
100%. I mean, you saw that a lot with Hyperliquid.
This episode is brought to you by Zcash, the decentralized digital cash that is encrypted to ensure agency and safety. With a fixed supply of 21 million and proof of work consensus, Zcash is encrypted Bitcoin. Buy, store, and spend encrypted Bitcoin using the Zcash-powered mobile wallet, Zashi. To find out more, visit their website or click the link in the show notes. Thanks to Zcash for making today's episode possible. Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply.
I do want to go back to the original thing that you were saying, where we were talking a little bit about like the dream, like all these tokens, their valuations are driven by the dream, and that Jonah, you said tokens don't go bankrupt, and we've all probably had this idea somewhat. Okay, well, yeah, in 2022 things got totally out of control, but people made a ton of money, things went up a ton. We said this in 2017. Oh, ICOs, most of these are useless, but then Cardano sticks around, and so everybody's question always becomes, why are you not wrong now? Like, what is happening now that makes it so different than everything else before? Whereas realistically, you could have made this same argument 8 years ago. Oh, valuations are going to come in. I will say, like, it does seem like things are changing right now. one thing that really stood out to me recently is that EOS got delisted from Coinbase. And I think that was the first time I've seen like a truly like next gen. At one point, EOS was the hyped. It was the next generation blockchain. It was the thing that was supposed to eat Ethereum. And it just failed massively, and it turned into a massive value extraction event. And there was a lot of, I think, real estate bought in Sardinia because of that. So that was nice, but it was it was one of
Largest
these,
the highest purchase
yeah,
price in Italy was bought by
yeah,
Brandon, I think.
brand,
Yeah.
yeah, like for 160 mil. But it's like it's nuts because now we're starting to see, okay, I think it kind of starts breaking the spell a little bit when something like EOS goes down, where you go, okay, you can raise $4 or $5 billion. You can be faster in theory than Ethereum, and it doesn't matter. It doesn't potentially matter.
I
Um,
I wouldn't argue this time is different. I think it's like every other cycle. There's huge drawdowns in the space. Even though the top 10 composition didn't change, you have huge drawdowns. I mean, Bitcoin, I would argue, is graduated now. Like the vol in Bitcoin probably continues to go lower as you have more like institutional flows and ETF products. But for the rest, you're sort of nothing changes this time around. You should expect to see 80% drawdowns, 90% drawdowns on these things from majors. And it doesn't change because again, it's all self-referential. You're in this loop that it's all like crypto is a great capital formation vehicle, 24/7, 365. Anyone that doesn't ex-US can now invest in levered NASDAQ plays and YOLO and roll the dice in the casino. Great, 24/7, 365. I don't think that's worth 1.5 trillion because you churn through that constantly. Like, in the same way that people like punt their paycheck to paycheck, and so you see these drawdowns, severe drawdowns, because there's no real economic activity beyond speculation anchoring the valuation of these things. And like liquidity really does dry up. Like when you're in a macro bear, you need like stimulus checks to really get people to come back and like punt your altcoin of choice. And so I don't think this time is any different. Now, the position that I take is the most important metric to follow is active users on chain. And A16Z came out with a great report on that, and that's really the elephant in the room is when are we going to actually break and grow the active user base on chain? Because that number hasn't really gone up. Yeah, and the same with the people, there's only so many people that can go into the casino and survive long enough because the longer you exist in the casino, the higher likelihood that you're going to be served a drink, you're going to get drunk, or you're going to get liquidated.
The
And
vig
crypto
is
is going
pretty
to
good
churn through
too.
that.
A lot of
Yeah,
transaction fees, 1, 2, 5% per trade.
totally. Like the MEV of networks like Solana, what I tell people is I want to build the largest chain in terms of active users. That doesn't mean that my chain is going to be the largest in economic activity, the largest in user bases, because we'll acquire businesses, we'll bring those businesses on chain, and make then the value extraction, like the fees that how I monetize users is very likely going to be lower than how you like the MEV attached to meme coin trading. That's very very extractive, and you're churning through that user base, right? Um, so
Yeah, it's not good. I mean, the other thing that's cannibalizing at least ETH is L2s. We haven't talked about that yet. Like everybody wants to talk about mega ETH. I think that
well, I got specifically flamed for that because
I saw that, Ollie.
people weren't happy by me saying, oh, it's we don't need another L2. The issue is not throughput, the issue is activity. And I mean, I do think those two things are correlated, but I don't think that we are bound by throughput right now. And I mean, at some point we will be, but it's not right now. But people were coming after me for calling Mega ETH and L2. I read there's this guy Brad who kind of like puts out, who's I guess part of Mega ETH, and he sort of wrote a rebuttal to me that I think, like, I really respect him for trying to engage in good faith, but I think at the end of the day it's still like, hey, like we're trying our hardest to bring people onto our chain, but I can't show you anything that's like actually real that will be used a substantial amount more than the current applications already exist. So it's like,
I think, yeah. Look, I'm an early investor in Mega ETH, and I think I'll always on the venture side be interested in investing in people that want to solve some of the problems. The last 4 years, like to your point, block space is increasingly a commodity, and the price of the block space has come down a lot. you're no longer in a state of affairs where you're paying $1,000 per transaction. No one in their right mind really would want to use the L1 when fees spike. So Ethereum is kind of cooked from that standpoint. The analogy would be, imagine, to your point around real estate or federal government. It's like Ethereum acts like a federal government, wants evaluations of federal government, but only collects state or city tax, because most of the tax is being collected by L2s. And so the revenue generation of an Ethereum, the L1, no longer supports a really valuation, like a credible 380, $400 billion valuation for ETH. And so that's kind of cooked. The point around Mega ETH is true for most teams that I sympathize with. It's like you have really smart folks trying to like push the limits on throughput and decentralization consensus. That's fine. Like, again, we've invested over 100 billion on infrastructure. It's like in the internet phase, there was overinvestment in fiber. You need like the smartphone, you need consumer applications to actually like eat up that excess of infrastructure. So block space, I think people just need to update their priors. Like, block space is no longer scarce. How are you going to fill that? And you want to fill that with quality demand for it, not pure speculative activity that is highly cyclical and self-referential.
So just to the point about quality demand for block space, and what you were saying about how it's about to get very illiquid as people get sort of ejected from the casino or liquidated or they go bankrupt or face ruin, basically, or just rage quit crypto, which we're seeing a lot of lately. Those two things could kind of converge, and there might be an interesting trade from the long side. Hyper liquid, I think, provided there is economic activity going on chain there that isn't pure meme coin gambling. Like, again, levered, to your point, levered trading of both stocks and tokens is a useful innovation for retail globally. So if they're buying back, if you have like a third participant, which is the Hyperliquid Foundation, using trading fees from real economic activity to buy back tokens in an illiquid market, I could see that thing squeezing pretty hard to the upside, maybe. So maybe that's what's going to happen. We're going to get like the dark fiber phenomenon of tech in the 2000s, to your analogy, where most tokens go down. Maybe things, quality assets like Hyperliquid, which could be considered like an Amazon or a Google of crypto, get sold hard. And then the real economic activity jacks it up over the following, the subsequent months and years. You just have to stay solvent to be able to play for that and not get long at whatever it is, wherever it's trading $37 right now, and have it go to $5 on you because of some collapse.
Yeah, I mean, look, I'm not disputing like the long-term promise of these technologies and like tokenized stocks, and you see it like opening financial markets and tokenizing stocks for the rest of the world is a massive, massive opportunity. You could probably make a solid argument to your LPs that Hyperliquid is a $40 billion asset, and it's all the burns are there. Just I come from a world of investing in enterprise software, and so you have contracted revenue on enterprise software multi-year. You can really underwrite behind that. It's recurring. You can't really get behind run rating. Pull up the Blockworks dashboard, like REV of these networks, like over the last 30 days, 90 days. Go through that list. Solana over the last 90 days, 150 million of REV total revenue, not earnings, right? Ethereum, similar. Hyperliquid is 5 million. So a lot of analysts in crypto or investors just look at that and say, oh, I'm going to run rate that the peak, and it stresses that. All I'm saying is, how do you think that revenue stream behaves in a down market? Because we're not in a down market yet. I think people are feeling the crunch. You kind of listen to earnings of like Chipotle's of the world, and the consumer's feeling a pinch. Other than XAI, everything else is kind of in a slog. Like, not just in crypto. You need to really get behind, like, crypto is a hyper macro asset class because you really, really depend on liquidity flows. Like, you have to believe central banks inject money into the economy, and that people have enough money to come in and gamble in the casino, whether it's polymarket to whatever it is that they're punting, stocks, meme coins, fundamental tokens, whatever. And so that's where I think most of investors in crypto play the relative value game, which is, hey man, Bitcoin's a tenth of gold's market cap, or less than that. Well, there's room to grow, and Ethereum is only a fraction of Bitcoin, and it's worth 400 billion. What if it gets to Bitcoin? And oh, by the way, Zcash is only 10%. It's only a fraction of Bitcoin. And then you go down, and Solana is only worth a fifth of Ethereum. And so, again, maybe on a relative basis you outperform, but the name of the game here is, to your point around staying solvent. Are you making money?
$1 million question for you, Santi. Let's say that you're right, and I agree that you are, that this $1.5 trillion, let's call it non-Bitcoin space, it should not be worth 1.5 trillion, and you could see an 80% drawdown. Let's say that, or maybe let's just make it a little bit more benign. Let's say that it goes from 1.5 trillion to 700 million as the vaporware gets revalued by investors and dumping. What does that do to Bitcoin, if anything, or can it occur exogenously?
I think there's a credible stance here, and you've already seen that the cycle Bitcoin holds and is less volatile, and it's just a different class of its own. And I could see a world where Bitcoin may go down to 80K or 75K, but the drawdown on the rest of crypto is much more severe. And there's a world where Bitcoin rallies and tokens just don't move as much, and you're already seeing that the cycle. So like Bitcoin's like a commodity, right? It's very different than I would characterize everything other than Bitcoin as a tech stock, and that's a valuation. You're competing for attention and flows against AI, against other parts of the market. And you're constantly believing and praying that those flows continue to show up and people continue to fly into Vegas and punt. And we built a 24/7, 365 casino, and that's pretty good. But just to give you some perspective, OpenAI has 800,000 users. It's a trillion, likely IPOs at a trillion. So on a per user basis, that's I think the math you got to do, right? Crypto, 1.5 trillion, excluding Bitcoin. And you have 40 million users. So you're telling me you have 20 times more users for OpenAI, and the valuation is not too dissimilar. Like that's the gap that we have on active users, right? And if you tell me, Jonah, hey, look, crypto is say crypto doesn't move from now, and we wake up one day and we have actually 500 million users on chain. You're like, okay, I can actually start to get behind the valuation for the rest of crypto. And mind you, some of that valuation 1.5 includes stablecoin circulation. So again, you want to see certain things show up, but the most important thing is just active users. Wallets moving money and where they're going. The beautiful thing of this, you will actually be able to underwrite that with high precision because you'll understand where flows are going. You'll understand if they're using Polymarket versus, Hyperliquid versus Uniswap, or a gaming application like Gonzilla. I don't know what I mean, but the quality and the activity also needs to be diversified away from speculation. We're nowhere near yet. I'd rather candidly buy OpenAI at a trillion and go long that than hold any position in crypto. And look, there's always like gems in a bull or bear market. Like there's pockets of crypto. I'm not suggesting like categorically just chop everything. However, I think there are certain protocols in DeFi and Deepin that you can wrap your head around evaluation and say, okay, gosh, it seems to be overlooked. And maybe with regulatory clarity, you'll be able to connect the token with equity and do all these things. I think it just takes longer, the regulatory clarity. And so why would again, it just goes back to, I never want to underwrite something with like stacked assumptions. X, Y, Z needs to happen. I want to make sure that Jensen Huang doesn't puke. I need to make sure that Powell has a good day and that regulatory clarity shows up and there's no government shutdown. And then people continue to want to punt this and that, so like probability of A, B, C, D happening, you stack all those together, you're likely going to be wrong in your underwriting process. It's not a clean bet.
Yeah, no, I personally, I'm willing to take that risk on the regulatory clarity right now. I think that's it. That's the only part that I'm pretty happy about. Like we're seeing Uniswap move forward. I guess the question that, Jonah and I try to answer a lot and that we think about is there is a shift coming. Like we believe that there's a massive shift coming where of that 1.5 trillion in outside of Bitcoin, a substantial amount of that is held in sort of the quote unquote wrong areas. But when you look at things like Uniswap or you look at things like Hyperliquid or Aave, or there are DeFi protocols that if you take the revenues and you look at the pricing, it's like, okay, these things could be actually fairly reasonably priced. And so one of the things that we're trying to think about, right, is like in a drawdown like this, like when stuff starts going lower, can we get a period of time? And my answer to this is yes, but I'm curious your answer. But can we get a period of time where you get things like Syrup and Aave and Hyperliquid and these other assets going up while the rest of the market is going down, because everyone's just like, okay, like I'm out of Cardano, right? Like I'm out.
And this is where I'm probably mid-curving it quite a bit, because this is where I've been wrong the most, which, sitting there investing in DeFi in early 2020s, and you would have like really and we were successful underwriting that thesis, but still the entirety of DeFi was worth less than Dogecoin. So this is where like markets have become hyper financialized, and I'm not here to discount the social mimetic desire. Like that's, I think, a huge part of the valuation underpinning that. And maybe someone can come in this pod and say, dude, that guy is crazy because he totally doesn't understand how flows and crypto markets work. It's like total mid curve. 1.5 trillion for memes is very supportive, and you could probably construct some analysis behind that. And some things good calls, but you have to believe on like it's fluffy, and I can't really wrap my head around that. I'll go back to cash flows and I'll go back to activity, and it just makes me nervous because I think we're like in the second half of like broader market cycle, like valuations everywhere. The market's gone up for a couple of years. Your mean reverting is something that I constantly think about to just analyze and make investments in crypto and markets and wherever. Like I can't, and so I'm a bit more cautious now. I think I want to be sure that the things that I'm holding, I can say, hey, look, this thing is actually cranking out, X amount of cash flow, and I can wrap my head around that. And if it falls 20, 30%, I'll actually put way more on the line and double the position and triple the position. I struggle with valuing and creating a reasonable framework for memes, even though I think they're super important and they could be worth 10 trillion. God knows. I mean, I constantly am surprised of the degenerate energy and activity in crypto.
This episode is brought to you by Zcash, the decentralized digital cash that is encrypted to ensure agency and safety. With a fixed supply of 21 million and proof of work consensus, Zcash is encrypted Bitcoin. Buy, store, and spend encrypted Bitcoin using the Zcash-powered mobile wallet, Zashi. To find out more, visit their website or click the link in the show notes. Thanks to Zcash for making today's episode possible. Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion CAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. As always, investments in blockchain technology involve risk, terms, and conditions apply.
So I guess just zooming way out for a second, macro-wise, the reason why I'm pretty darn excited about Bitcoin and the broader landscape for crypto is that I think that, I do think we're going to get it, like affordability is the crisis of our time right now. That's what's being communicated via the recent elections. That's what the Trump administration is focused on. Inflation is global. Basically, people are struggling, a lot of people are struggling to afford daily life. So against that backdrop, there's kind of two routes that governments can go to solve it. One is socialism, and that's bearish for everything, all assets. The other is stimulus. And I think that the current political backdrop in the West is still, you're looking at governments that are run by people who are going to lean towards stimulus, not like Pol Pot or Mao style redistribution. And so I think that in general, that plus the fact that blockchain has already disrupted financial back office applications and just hasn't been allowed to proliferate until 6 months ago when it went from being illegal to now legal, you're sort of setting up for a short-term cash inflows that should buoy all assets, including speculative ones like our space, as well as like a longer term mega trend, maybe tech in 2000, where it doesn't just happen. Oh, you don't go to 2025 level tech prices overnight, but you're at the beginning of a 25-year, just sort of upswing in crypto, maybe stable coins or things that are hard to invest in, but just adoption of crypto. So like broadly, I'm constructive. The current price set, I agree, is challenging. So against those sort of two conflicting features of the market, Santi, I kind of wanted to just ask you, you're about to, or maybe not about to, you're at some point you've talked about launching a token and you're launching a blockchain. How are you thinking about doing that in such a way that token holders benefit, but you don't have to get forced to give up too much of your FDV in a bear market?
Yeah. Look, excellent question. We get asked this a lot, like, why would you launch another chain? We don't need another chain. And I'll say, for a very specific reason, we'll go and acquire businesses and plug in this technology to make them more efficient. We'll cut costs, we'll improve unit economics. We drive all that activity and settlement to our chain because we don't want to leak that value. Like, there will be apps in the Ethereum ecosystem, stablecoins and DeFi protocols and deep in protocols that are going to benefit from bringing a user that has just not existed in crypto before. It's a user that doesn't care about speculation, that's not here because Bitcoin's at 100K. It's a user that doesn't even realize that crypto's working on the back end. They'll feel the impact. They'll get a loan, the rate is lower, they'll get a stable coin that for all intents and purposes for them is $1 and they're earning yield like a money market account. And I think that's where we see a path towards becoming the largest chain in terms of active, real economic activity. Our KPI is, can we buy businesses where there's a core service like mobile or some other utility and make those businesses, financialized, becoming banks, right? And bringing that activity on chain. And I think that's where, again, going back to why we have this issue in crypto, I think is I want to bring not casino flow into our chain. I want to bring real economic activity. And I think the multiple attached to that chain should be very different than the multiple that you have in other businesses that are in other chains that are just very cyclical. And that's why we have a chain, right?
Yeah.
As we think about like this idea between tokens and equity, look, it's very simple. I want people to look at the chain and say, gosh, these guys own 100 businesses. And those businesses there's a stream of activity coming through because we own the user relationship. We'll direct that flow to the chain. And so you can underwrite that from if there's $1 billion in fees that is generated by our chain, you could say, yeah, these are real businesses. They own them through their fund, and other businesses that can plug into the chain. And you say, okay, I can actually underwrite that from a reasonable multiple perspective, and people can come to their own conclusion about that.
That's why I asked the question though, because sorry, Avi, I won't ramble too long. I asked not because our listeners tend to get upset when we try to go into like the lore behind blockchain development, but more just like you're familiar with trading, you're familiar with tokenomics, you're familiar with all of this stuff, and you're launching one right now. So basically, listening to you, I hope that our listeners walk away with some idea of like what's in an idea of an example, a concrete example of something that's investable in this market,
Yeah. Look, we'll have a private equity fund acquiring real businesses that you have to be accredited. There's a number of constraints there. But we'll have our inversion chain, and we will have an inversion token, and we'll use that to to settle all the activity on the chain. Um, we raised a round earlier this year for Inversion Labs, which is we're building a blockchain. We're hiring kind of like a Palantir model. We have forward deployed engineers, product people that parachute into companies and do the transformation. I was just with one of the larger investment banks here in New York, and they historically have been very anti-crypto. And now I was talking to their investment bank, their private bank, and they're saying, "Gosh, a lot of business owners call us today and say, how do I use stablecoins? Like, I want to implement this. I hear Stripe's doing it, and I hear JP Morgan's doing it. I can tell you from our standpoint, we don't have a problem with sourcing demand for companies that want to get acquired or want to utilize this technology. Um, so we're going to focus on that, and of course, as most projects in the space do, we'll launch a token. How we do it, I think we're paying a lot of attention to the regulatory environment, how to map out, all this cash flow that can be generated as you make businesses more efficient, and how we connect that to the chain. But in a very simplistic way, you'll have a lot of durable recurring fees in terms of MEV and blockchain fees settling. So you can think of it like if you want to do apples to apples to a network like Ethereum or Solana, you will kind of do this analysis, right? And in blockchains, you can inspect in real time. Hey, how much is MEV being captured? How much of fees are being captured here? How many users do they have? What type of activities on this chain? So I don't know if that answers your question. Like, of course, we got to be guarded about, paying a lot of attention to.
No,
No.
Santi, I need to know exactly what company you're buying right now, so that we so that we can go in
Right,
there
right.
and bid it up.
We've looked at
I
public.
agree.
We've
I was
looked
like,
at
but that is sort of a real question. It's like, what type of business
what type of
benefits the
business, right?
most? Like what type?
Today, look, long term, it's like you're sitting there in early 2000s and saying every business is going to use internet and software. And that's just what's going to happen over the next 20, 25 years. Businesses are still running on spreadsheets, especially like small businesses, um, like middle market businesses. A lot of those we're looking at family owned businesses, like technology is not core to what they do, but they can be made more efficient with technology. But just for fun, hypothetical, fun exercise here, it's too big for us right now. But Western Union, you've heard me talk about Western Union. Trades at 4 times P ratio. Now you tell me,
Better
would you
than any
rather?
crypto.
Again, this is like price dictates a return that you get. The core thesis that I have personally, I'm a huge techno optimist. I love technology. I think technology is what makes businesses more efficient. However, I think because of this, the market is drunk on that sort of techno optimism and leaves certain businesses for dead. So Howard Marks talks about price being the main determinant of returns. Now, market pendulum and momentum swings in the extremes. Business fundamentals kind of don't deviate as much. So again, steel mill operators that were going bankrupt traded at 8 times P ratio. I look at a business like that, and I get excited. I'll start doing work and say, why is it trading at 4 times when the market is trading at 25, 30 times? Again, mean reversion. And I think margin of safety is the name of the game. And so we look at a business like a remittance operator, and then you start digging deeper and say, okay, they have a lot of trust. Western Union is a very recognizable brand. If you're if you're an immigrant in the US, you're likely going to want to go to Western Union as opposed to MoonPay or whatever. And so can you make that business more efficient with technology? Can you make that business more efficient with stablecoins? Then you start saying, okay, well, they pay most of their fees. You look at their cost structure and say most of those fees are sourcing liquidity in local markets. If you, Avi, want to send money back to Israel or whatever, well, they're going to charge you 2, 3, 4%, and they're going to hose you on the FX conversion rate. They'll kind of hide it in a very interesting way. And then they'll have to pay a local merchant, convenience store, whatever retailer in Israel to source that liquidity to go back to the Israeli currency. Well, what happens in a world where on the back end, your family member doesn't want to actually go to local currency because now they have a digital wallet? So you basically now can cut that big part of the cost structure for that business. Cutting costs is the name of the game here, gents. It's like I don't ever want to underwrite that we're going back to like financial engineering and private equity thing has been a thing, right? It's like, oh, let's buy a business, put a bunch of debt on it, fire half the workforce with AI and
DATs. That sounds like financial engineering.
financial engineer. Look, that's not the game we play. We simply can first look at a business of, does it have scale? Does it have distribution? Does it have trust? If it has trust, you can do so much with that business.
Okay,
And
so
then you say,
here's a follow-up question. Sorry to interrupt. So a lot of chains are trying to do what you're doing, but without the private equity angle. So instead of buying businesses and putting blockchain into them, there's a blockchain angle and they're building a business. Like Maple Finance is a great example. Plasma is another great example of that, right? They're building a stablecoin network, which is supposedly going to have real economic activity, and there's a token too. But anyway, I guess my question is, what's the difference between, as investors look at inversion or other tokens in the altcoin space that's very fraught with risk right now, when they ask themselves, hey, okay, Santi says there should be real economic activity in order for me to invest in one of these tokens. Fine, we're all in agreement there. Digging up one layer deeper, the question for you is, what's the difference? Okay, if there's some economic activity, if that box has been checked, what's the difference between being like an equity holder, or in your case, like a private equity LP, and a token holder? Does it have to be like hyperliquid, where the token needs, or the project needs to say, all right, 95% of this real economic activity is going to buy back the token in order for it to be, you get the green light on it as a token investor? Or is there some other way that you're going to link real economic activity back to the token holders?
Yeah, look, in a perfect world, you map out all the cash flows that you make back to the chain. We're observing the regulatory environment, and we'll adapt based on that. We've got to work what we have. So again, going back to hyperliquid, if we have one user, a whale in hyperliquid, it's trading, right? It's using hyperliquid, it's generating fees. Think of our go-to-market in a company that we acquire is that whale. That company is bringing massive amounts of flow that, by the way, is sticky because we control it. Unlike Maple, for instance, a lot of the RWA protocols are doing the BD game. They're convincing, they're finding, they're underwriting business. And look, all the credit to Sid. They go out, they underwrite the deal, they'll bring it on chain. I think there's a kind of a principal agent dynamic there. We're putting equity on the line. Like, we're putting our money on the line to buy the business, and we control it. And because we control it, we can direct that flow to the chain. And so there's a very clear connection, right? In value creation story, which is where the incremental business that we buy brings more value, more stream of settlement fees to the chain, right? So that's a simplistic way to think about it. I'll tell you why, I guess, a big part of starting Inversion was going and talking to a lot of the projects in crypto. And look, this technology's come a long way. The UI UX has come a long way. The biggest problem that we have as an industry is the go-to-market, right? Convincing businesses, convincing users to come into and use this stuff is very hard. And a testament to that is we haven't really grown the number of users on chain. So when talk to Coinbases of the world, and building distribution is very hard, time consuming, and expensive. I want to acquire distribution at a really good price. Again, if I buy a business like Western Union, hypothetically, it's like 4 billion. Okay, that they already have an existing user base that we can kind of activate without them thinking about all these things. Like, we can extract away all that complexity. And so again, it's customer acquisition, right? And it all really boils down to unit economics, right? If it were easy to convince businesses, if it were so easy to convince users to come and use this technology, then I wouldn't be wanting to acquire these businesses and take a private equity approach. But it just isn't. If you look at the evolution of technology, it's kind of really hard to convince these businesses. So like, there's a couple of things that you never want to assume, like changing consumer behavior. People are lazy, man. They don't want to switch bank accounts. They don't want to try new shit. And it's a fair question to ask. Like, if you're a skeptic of crypto, I think we don't have a good answer when someone says, "Hey, man, look, I hear you on stablecoins. Carlson brothers are hyped up on it. They say it's room temperature semiconductors, greatest thing ever." Now, you let me know why we don't have more than 40 million active users. If stablecoins are truly amazing and everyone wants dollars, you let me know when we have a billion users using this stuff. And so again, as you think about relating it, like, so how do I invest in this thesis? Because stablecoins are going to continue to proliferate. I think you invest in this thesis by, again, investing in companies that are going to use this technology and benefit from it. In the same way that you can build a thesis around AI, like, who's going to build more value? Like the AI startup, or Facebook, or some company that can use, like a law firm that can use AI to fire half the workforce and be 10 times more profitable on a per employee basis. Like, that's sort of things like value accrual historically has been like, it's going to accrue in the infrastructure layer. But I think user aggregation theory is very true. Like, if you control the user, you monetize that, and then you utilize this infrastructure that is open, public, decentralized, and is lowering the cost to become a financial services company, and you can capture that flow. And so that's my thesis here. Like, the last 10 years have been, succinctly, the last 10 years have been 100 billion invested in infrastructure. If you were early Solana, Ethereum, Filecoin, whatever, you would have made a ton of money. I don't think that thesis and that strategy works over the next 10, 15 years. I think you want to now think, who's actually going to capture more value, Robinhood or your new startup stablecoin issuer? Who's going to capture more value?
Yeah,
Your
I think
DeFi.
this happened a little bit. Sorry, good. I
No,
thought you
no,
were on.
no.
Oh.
I think the point was made.
No, I'm with you. I think one of the things that I realized probably a few years ago is that at the end of the day, like you need applications that are driving a substantial amount of activity to a platform. And the reason that people were investing in infrastructure, from my personal perspective, is that there were no applications to invest in at the time, or you didn't necessarily know what application was going to win. And so people viewed it as an easy, safe sort of catch-all. Like, let me invest in the infrastructure at some point. This will give me exposure to the idea, even if the specific investment is not the thing that works in 10 to 15 years. It gives me access to the idea of crypto. And I think what we've sort of come to now is an understanding that it's about the actual, and always has been, it's about the actual applications. Like people used to make sort of they would say things like, well, the underlying crypto network is like the underlying email protocol. And that to me was always like a really bad argument, because the underlying protocol like shouldn't make a ton of money, in my personal opinion, long term. Like it should be the things that live on top of the protocol that end up making money. And then at some point, yes, the underlying protocol can make money. But I think when you look back also to like the early 2000s and you think of the internet boom, there were obviously today tremendous amount of company value created by startups that were the first to implement internet technology. However, there was also a ton of productivity gained by companies that had nothing to do with the internet, that just ended up taking like restaurants, right? Like setting up a website. I'm sure the bookings went up for individual restaurants because people were able to find them and go to them and see them. That's why like food and beverage spending is up in the United States. It's easier to go find these things now, like over versus 30 years ago. And so I think that's kind of what you're doing and thinking about in crypto, is that yes, there are companies that will be created crypto first and will win and will be huge, but you're missing the forest for the trees, and that there's like a huge other sector here where you're going to have to actually integrate crypto at some point, one way or the other. And I can take advantage of that. Now, the question is like in crypto, like everyone I think is still focused on the wrong stuff. And I kind of figured this out with the Mega ETH, and then everyone's really excited about Monad. And I'm just not, same as you, like I'm just not excited about these things anymore. I'm excited about what's being built on top of them, and then maybe by extension, the thing itself, which again is why like I know Plasma's gotten a really, really, really bad rap recently, just because it just keeps going straight down in a straight line. And that tends to make people upset with projects when they go straight down in a straight line. People get very upset. But at least like, they're basically trying to build a neobank, and I respect that they're trying to build a company, not necessarily a platform.
If you look at you did the tech analogy just now. Like if you look at what happened after 2000, everybody did the same thing. Like Cisco was that like the biggest company in the world for a hot second? I mean, the craziest thing is it's playing out exactly the same way in crypto, where everybody thought you had to invest in infrastructure, but what actually came out of that sort of tech bust and subsequent 25-year super cycle was the things that really rallied, like Google and Amazon, were apps. They were applications. They were real use cases. So I think to try to like sum all of this conversation into one like little nugget, it would be the paradigm has shifted. Ignoring Bitcoin for a second, the only thing that's investable here on out is basically killer apps. And if you're investing in infrastructure, you're investing in Cisco in 2000, AT&T in 2000, whatever else garbage, like nobody, local broadband cable providers in 2000, like the stuff that didn't 1000x. And I guess Santi, you're trying to buy killer apps. Somebody else might make one. Maybe Hyperliquid is, maybe it isn't. But like that's what we got to look for, is killer apps, and probably not at current prices because they're terrifying.
Mantle is pioneering the blockchain for banking, a bold new category combining traditional finance with the power of Web3. With UR, the world's first on-chain money app, users can manage fiat and crypto side by side using a Swiss IBAN account in Euro, US dollar, Swiss franc, and RMB, all posted to the blockchain. Backed by the Mantle network, UR is the access layer that unlocks a purpose-built vertical platform for on-chain payments, trading, and asset protocols, including METH, MI4, and functions FBTC. All economic activity within UR will be captured by Mantle Network to further drive value to MNT token holders. Follow Mantle on X at Mantle_official for more. As always, investments in blockchain technology involve risk, terms, and conditions apply.
I am kind of bullish on Bitcoin still. Like I'm still bullish on BTC. Like I do think that just to like throw a little sprinkle of trading in here, I think that we've gone down too far too fast, and like regardless of anything, like you probably see a bounce soon, because it's very rare that everything goes down. I mean, gold is going down, Nasdaq is going down, like AI is going down, Ford is going, like uranium is going down, like every single thing is going down. And what that tends to mean is that it's just like general repositioning and deleveraging. And then once that's over, you get at least some sort of bounce. Now, like how high that bounce goes is sort of, like I personally don't think the stock market bubble is over by any chance. I wouldn't even necessarily call it a bubble. I do think that we're gonna have a good end of the year. When it comes to crypto, I'm out XBTC. I'm a lot less optimistic. Like I'm back to being an ETH hater.
I'll say a couple of quick points on that. Like, Jonah, you're absolutely right. Look, Cisco never recovered from his all-time high. And I think it's one of those things where I think a lot of these things are grossly overvalued. And that's just a downtrend that is hard to overcome. You have some fundamental architectural issues of value capture, like we discuss here on Ethereum. You also have just overvaluation. The most important thing to solve is distribution. And people, like, let's not forget, this is open, public, decentralized infrastructure. And Stripe launching Tempo is kind of a warning shot. It's like, I get the Switzerland model, but this could be co-opted, this could be forked. And so I think it just, to your point, Avi, I also agree with you. Like, I feel very comfortable holding Bitcoin. I think Bitcoin serves a purpose in pretty much everyone's portfolio. Getting off zero, you're going to continue to see that trend. I'll underwrite that. Like, I actually like Bitcoin here. I'm rotating a lot of stuff in a Bitcoin, and I want to hold it in some measure in my portfolio. But as I spend, I love this technology. I love crypto. I think the most important thing is the value capture will happen to deployers, not infrastructure. And there's still going to maybe be some incremental protocol that creates a better kind of mousetrap, better infrastructure. I'm not totally discounting that thesis on the early venture side, but there's just an overinvestment on infrastructure. And what we need is, I think, more value be captured by the Apples, the Googles, the Amazons that realize, hey, 2000s are very different than the 90s. We actually can use a lot of the software and internet, and the price of that technology has come down dramatically. And again, block space has come down dramatically. So what can we do with that beyond speculation?
Hopefully make a lot of money.
not a lot of money
for everybody involved.
Not a lot of money out there right now from the long side. People are hurting. My gosh, the sentiment is so dire. Although what I will say is, like, and Santi, I want to get your take on this too as we get toward the end of the podcast. I think I like Bitcoin too here. I'm not a short-term trader, as everybody knows, but I will be adding if it trades down below 90K, which we're getting close to. I think that the OG selling is not going to happen here. I don't think we're going to get forced DAT selling of Bitcoin. And I think that I do believe in the Bitcoin to a million thesis. I think that we're going to get, like, the affordability crisis is bigger than crypto, and governments are not going to solve it with communism or socialism right now. We're like, look who's in charge. The guy wants his face on Mount Rushmore. He doesn't want to be the next Herbert Hoover. We're going to get something big, and I want to be holding Bitcoin when that debasement occurs.
Yeah, and even if it goes to 1 million, you'll be still at a fraction of digital gold. And look, something like Bitcoin is the perfect meme. And there's only one real digital gold here. Maybe people can argue Zcash is, but yeah, I think you're absolutely right. And institutions can't really pronounce Solana or Ethereum. They definitely now understand Bitcoin, and they're gonna continue. I think that is a secular trend that I'll get behind on over the next couple of years. And so I'm there with you.
I got a great question for you. You're talking to institutions. You're doing like crypto X TradFi stuff day to day. we on this podcast, Avi and I are constantly going back and forth about how as the infrastructure eats financial plumbing, flows will come into crypto. What does that look like? Like when you talk to institutions, are they like, well, in order to, replace some payments rails with crypto rails, I'm going to open an Ethereum wallet and buy $1 billion worth of ETH? Like obviously not, but or is there something different they're telling you? Like how do you view that inflow occurring?
It's an trillion-dollar question, I would say. I was this morning just with one of the larger banks in the world. Very, very old school, traditional. They historically have not wanted to get exposure, not even offer Bitcoin products or crypto ETFs to clients. Their board last November said, hey, we got to figure out something here. And now they're offering ETFs to clients. So I think like it goes back to distribution. Like what are these financial institutions going to want to offer their clients? Like one of the paradigm shifts here is Wall Street can make money off of this industry. So Larry Fink is the perfect evangelist. So this is my point around you had all of these perfect headlines and prices are going down. That just tells you everything you need to know about where we are. Like just there's a massive overinvestment and overvaluation in some of these networks. Um, but yeah, I think JP Morgan launching the deposit token on Base is pretty telling. Like I don't know exactly what went into that thought process, but it was something probably along the lines of they've had an internal team working on blockchain since 2015, Onyx, then Connexus. They've been experimenting with that, and most banks have teams, dedicated teams internally to try to figure this out. Like, hey, repo 24/7 365, like settlement over the weekend. Like these are some pain points that they want to solve. um, they're looking at Figure, what they've done there to or like streamline a lot of that workflow. Where they're going to deploy, I would get behind the argument of like most of them probably look to Ethereum first before anything else, and likely just stick to Ethereum. JP Morgan launching a base is probably like, hey, they
But that
probably
doesn't
want
mean
to
they're
talk to.
buying ETH. That means they're like
No.
launching stuff on Base.
Yeah,
Yeah.
and this is again, it's such a nuanced take, but it's a super important one because just because we have more adoption doesn't mean the value capture is going to be there. Like Ethereum, okay, you launch an Ethereum. Where in Ethereum did you launch? Well, JP Morgan launched on Base. Okay, what do you need to believe for Base to accrue all sequencer fees? Well, it doesn't have a token. Okay, you can't invest in that. So maybe go buy Coinbase stock. Okay, is that trading reasonably well? Okay, what do you need to believe to support a price to sale ratio of Ethereum coming down from 200 to 400x? Like, I want to buy stuff at like 10x for the sales. Like, you know what I mean? Like Ethereum is 400 billion. It's generating maybe 1 or 2 billion in revenue, not earnings. God damn, you need way more Larry Finks and Jamie Dimons of the world to get behind that. So again, it's not there. And the last one I'll say is like you saw this a lot in the tech boom. Like businesses like Uber just didn't have good unit economics, and it's one of those things where like great service, but don't confuse great service with a good investment. Uber penetrated markets, expanded rapidly, delivered a phenomenal service to people, but it wasn't profitable in unit economics basis because the customer acquisition costs were so goddamn high. They were offering incentives to people, and that goes back to my point earlier, which is building distribution. Even for a beautiful service like Uber that competed against taxis, which provided a terrible service, was goddamn very, very hard. And it took them, they just barely started becoming profitable in core cities like San Francisco and New York. Some cities are still not profitable. And so again, everyone's a genius when rates are zero. And there's so many businesses that like got off the ground because we were in record low interest rate environment. You needed that. But building distribution, whether you're in tech or crypto and any other business, is very, very hard. And so I'd be a little bit cautious to just do the simple math around the institutions are coming, they're going to deploy in Ethereum over any other network. This is a path to $1 trillion. It's like, not really, man. Like the value capture is not there for Ethereum.
Yeah, poor Tom Lee just eviscerated him in his Ethereum thesis. But yeah, no, it's I think those
it get clicks, man. But like
it does.
I'll say this: just
But
because
that's
JP Morgan,
crypto in a
just because
nutshell.
your guy in the bank like listen to Bankless and somehow believe that this is the world's supercomputer. Yeah, man. Doesn't mean that Ethereum's going to be worth $1 trillion. I'm sorry, guys. It maybe is worth at this price like 10 times sales, maybe.
You know what it is? It's like it's a holdover of what crypto used to be like in 2021 and before, where you joined a camp and you stuck with it. and whatever the actual reality of the situation was didn't matter. It was, I got in through Ethereum, or I got in through X, or I got in through Y. Like, I'm a chain linker, or I'm a Ripple holder, I'm a Ethereum holder, and it's like that's what the DATs are kind of like reintroducing, in my opinion, in a way. And they kind of like need that to be true. Like, Tom Lee needs it to be true, obviously, to make a ton of money, but it's just not true in any meaningful way. So no, I'm with you. I'm back to being a hard. I made a name for myself over the last 2 years by being the biggest Ethereum hater that's ever existed. 2.5 years ago, I said that Ethereum was going to be the Ripple of this cycle, and I think it's like kind of heading that way. Except Ripple's actually done pretty well.
We even got an angrily worded letter from both of the Bankless podcasters.
Yeah, they said they sent us a cease and desist. That was pretty funny.
Oh, wow. Look, man, I'll tell you the thing. I'll leave you with this, like price to sales. Because when you look at MEV, these dashboards, they all kind of say MEV, you know, that's a revenue of these chains, right? And they confuse that with earnings. Like they'll throw in there like staking rewards. I'm like, that's not revenue. That's not earnings, right? Look at cash flow of these businesses. You know, you have category killers in the public markets. Like anything above 10 times price to sales is growing dramatically. It has contracted revenue. Like even the best SaaS companies in the world, you know, they have maybe 10 to 15 times ARR, recurring revenue. Underwrite a thesis. If you're Tom Lee, I mean, I think he's a very good, like, you know, public speaker or whatever, but like fundamentally walk into a committee and give me the reason why I should buy an asset that is trading at, you know, 100, 200, 300, 400 times price to sales when revenue is not recurring. Even though you could say it's high growth, like maybe get behind the growth piece because all the institutions are coming. All right, great, you know. But again, it's one of those things where you just got to stay disciplined, man. And rule number 1 is never lose money. Rule number 2 is don't forget rule number 1. And this is why I titled my blog post today. I said, you know, thank you, dear LPs. We outperform Ethereum, but the fund's still down 80%. How many times? If you have fund managers, how many times has that goddamn letter been written?
Too many. Hopefully, and hopefully never again.
No. At least not by any of us.
But this time is not different, Avi.
I know. It's we're gonna go back there, but at least for now, we got people like you coming on podcasts like this, spreading the truth to people. So we appreciate you coming on, man. This has been fun. This is awesome as usual.
Yeah, amazing. I learned a lot.
Please forward all the criticism and whatnot.
We will. Don't worry. You think I'm taking? You think I'm going to hold on to that for myself? It's going straight to you.
Yeah. I appreciate what you guys do. Thanks for having me on, and really good discussion.
Likewise. Let's do it again sometime. Fun. Thank you, Santiago.
For sure.
Take care.
Thanks, John. Take care.